The silver market has not clarified. It has compacted. Lower timeframes are unstable, signals colliding, price moving one direction while physical metal moves another. When two realities diverge that cleanly, the people who survive are not the fastest traders or the sharpest analysts. They are the ones whose psychology was already calibrated before chaos arrived. Because this is where most people lose. Not slowly, not over time, immediately. The market does not punish ignorance gently. It removes people from the game. One bad entry, one emotional decision, one trade built on hope instead of structure, and suddenly the account that took years to build disappears in a week. That is not dramatic language. That is simply how markets operate. The story is as old as finance itself. Panic buyers rushing in at the spike, panic sellers dumping at the volatility. And somewhere above that noise, institutions and well-prepared players quietly accumulating advantages that compound into generational wealth. Wars change, economies change, governments change. That story never changes. Which is why we do what we do here. Data every day, numbers every day, primary sources every day. Not opinions designed to make you feel good, information that allows you to interpret the environment yourself. Because nobody knows your risk tolerance better than you. Nobody knows your financial pressure better than you. Nobody is responsible for your decisions except you. If 10 minutes of data feels like too much work, this channel is not for you, and that is fine. There are thousands of places on the internet designed to make markets look simple. This is not one of them. But if you want to understand what is actually moving beneath the surface, sit down and pay attention. Silver sitting at roughly $82 Western spot as I record this. Not long ago, it was testing $84. The move down was not violent, but it was decisive enough to remind everyone that the lower time frames are still fragile. Momentum has weakened. The tape is not clean. And anyone pretending otherwise is selling you confidence instead of analysis. The honest read right now is simple. The market is waiting. The event it is waiting for is tomorrow's non-farm payroll report. But before we get there, we need to build the broader picture from the ground up. Because if you are only watching the paper price in New York or London, you are seeing maybe half the story. Shanghai is still telling a very different one. Western spot sitting around $82. Shanghai futures closing closer to $95. Shanghai physical spot trading even higher in certain sessions. That premium hovering in the double-digit range is not noise. It is not a rounding error. It is a signal. A signal that the Eastern physical market is pricing silver in a fundamentally different reality than the Western paper market. Now layer vault data on top of that. The Shanghai Futures Exchange reported another notable inventory decline this week. Hundreds of thousands of ounces leaving vaults in a single session. Total exchange inventories drifting lower again, continuing a trend that has been building quietly for months. Not a collapse. Not a dramatic crash, just a slow, steady, relentless removal of physical metal from the system. Meanwhile, across the Pacific, COMEX inventories are showing the same pressure. Millions of ounces moving out of vault systems over recent sessions. Metal shifting categories, metal leaving custodians, metal simply disappearing from the registered supply available to back futures contracts. Registered silver on COMEX has now fallen to levels that would have looked alarming just a few years ago. Total inventories hovering near one-year lows. Open interest in silver futures sitting at some of the lowest levels the market has seen in over a decade. Think about what that combination actually means. Fewer contracts, fewer participants, less metal backing the system. When an exchange begins enforcing limits aggressively, it signals volatility risk, position concentration, liquidity imbalance, and potential delivery stress compressing into the same window. A casino does not lose power because it runs out of chips. It loses power when the players stop showing up. Open interest falling to decade lows tells you something about participation. Either traders are stepping away because volatility has become unpredictable, or liquidity is quietly migrating somewhere else. Neither explanation is particularly comfortable. Now, widen the frame. Because one of the most interesting institutional footprints in the silver ecosystem continues to come from Jane Street. New filings, new option data. The picture is clearer now. Jane Street currently holds an equity exposure tied to SLV sitting well into the billion-dollar range. But the equity itself is not the real story. The real story sits in the derivatives layered on top of it. Call options covering tens of millions of underlying SLV shares. Put options covering tens of millions more. The combined notional value of those options stretching well above $5 billion. When you see positioning like that, understand something immediately. This is not a directional bet. Institutions of that scale do not gamble on simple up or down predictions. The underlying equity is the anchor. The options book is the engine. Volatility itself becomes the product. And the volatility environment in silver has been unusual. Implied volatility rising even while prices climbed earlier in the year. Short interest increasing during price advances. Borrow rates remaining oddly calm compared to previous squeezes. Shares available to short staying relatively abundant. Those ingredients do not normally coexist in a clean market. They suggest a structure where sophisticated players are trading the mechanics of the system rather than simply the direction of the metal. That structure has historical precedent. The custodian behind SLV remains JP Morgan, the same institution that paid nearly $1 billion to settle federal spoofing charges related to precious metals trading. That settlement was not speculation, not a rumor. It was a closed case. What matters today is not the past fine. What matters is that the architecture of the market has not fundamentally changed since then. It has simply grown larger. Now, step back from metals entirely and look at the macro backdrop pressing against this system. Energy markets under stress again. Oil hovering in the high 70s, pushing toward levels that start feeding inflation expectations. Geopolitical tensions across the Middle East continuing to threaten shipping routes carrying a significant portion of global energy flows. The Strait of Hormuz alone handles roughly 1/5 of global oil shipments. Any disruption there does not just raise energy prices. It cascades into shipping costs, manufacturing costs, food costs, and ultimately, consumer inflation. Central banks spent 2 years fighting the first inflation wave. If energy shocks create a second one, monetary policy becomes a much more complicated problem. At the same time, unusual signals from sovereign gold activity. Several major Chinese banks reporting physical gold bar inventories sold out through retail investment channels, premiums rising in local markets, retail demand accelerating faster than expected. China's population tends to move toward physical metals during periods of financial uncertainty. When that behavior appears simultaneously with vault drains in silver and rising geopolitical stress, the pattern is worth paying attention to. Today's economic data was relatively mild. Initial jobless claims slightly below expectations, continuing claims slightly above. The result, predictable. Dollar caught a small bid. Precious metals reacted mechanically, sliding lower in paper trading sessions. Silver dropping from mid-83 earlier in the week to roughly 82 today. Did anything about the physical market change because of that report? No. Vault withdrawals did not reverse. Shanghai premiums did not collapse. Inventory levels did not refill themselves overnight. Paper markets responded to the dollar. Physical markets continued doing what they were already doing. And that difference matters. Because tomorrow's non-farm payroll release is one of the few data points capable of moving the dollar hard enough to shake the metals complex in the short term. Strong print, dollar pushes higher. Downward pressure on paper metals. Silver probes lower. Disappointing print, dollar weakens. Metals find relief. Momentum traders step back in. That is the binary setup sitting directly in front of this market. But this is the moment where psychology becomes more important than prediction. People tend to believe markets move in straight lines. They buy silver at 80, expecting 100. When price pulls back to 82 or 81, they start questioning the entire thesis, confusing short-term volatility with long-term direction. Others experience the opposite problem. Price runs to 85 or 86, and suddenly everyone who missed the move feels compelled to chase it. No plan, no defined entry, just the emotional discomfort of being left behind. Both reactions come from the same place: emotion replacing structure. A thesis is not a trade. Silver will go higher is not a trade. A trade has an entry level, a stop if you are wrong, a target if you are right, a defined size that does not destroy your account if volatility spikes, and a time horizon that matches the structure of the idea. Without those elements defined before you click buy, you are not trading. You are reacting. And the market is ruthless with reactive participants. Right now, the short-term tape is unclear. Dollar firm, liquidity thin, open interest low. Tomorrow's NFP report sitting directly in the center of the board. The bearish argument is straightforward. Silver weakened from $84, dollar stabilizing, futures participation thin. Macro uncertainty could trigger liquidity events where everything sells regardless of fundamentals. Those risks are real, but the physical market is sending signals that refuse to disappear. Vault inventories trending lower across multiple exchanges. Eastern premiums holding despite Western price weakness. Institutional positioning expanding into multi-billion-dollar derivative structures. Those are not opinions. Those are observable data points. So the question I leave open tonight is simple. If tomorrow's payroll report pushes the dollar higher and paper silver weakens again, does the physical drain slow down as prices fall? Or does it accelerate as buyers step in to take advantage of the discount? Because if the second scenario begins to unfold, the divergence between paper pricing and physical demand will become increasingly difficult for the system to absorb quietly. And that is when markets tend to change character very quickly. Invest with logic, not hype. OG John XX out.